All right, it is 10:30 on the dot. So we're going to go ahead and get started. If we have a couple people come in late, that's perfectly fine. But my name is John Williamson, and I'm one of the group product specialists here at IHC. And today we're going to be discussing our small group level funded product called Simplified Funding Concepts, or SFC for short. So we're really excited to be doing this webinar here for Wright Insurance, and it's a new relationship for us, and we're really looking forward to getting things kicked off here in 2021. And on the call with me today is another one of our IHC Group product specialists, Grayson Clark. We are both located in Columbus, Ohio, but we have both worked Michigan on and off, myself for about the past 10 years, and Grayson's been with IHC and involved in Michigan in varying degrees for about the last 3.5 years. So we've got a decent handle on the market, and I think we can bring some value not just with our level funded product, but some of our other products as well. Now, again, thank you for taking your time. I hope we can provide some insight into our level funded product specifically and how we can help your clients secure lower costs in terms of premium and potentially out-of-pocket expenses. And Grayson, I think you wanted to touch on just kind of some housekeeping items before we really get into the presentation here.
Yeah, good morning, everybody. Thank you for taking the time today to listen to our spiel, so to speak. We want to get you in and out today in right at 30 minutes. So in the interest of time, we are going to be answering questions on the back end of the presentation. But if we don't get to everybody's questions, don't worry. We will be following up after we wrap up today.
And everyone will be able to submit questions in the question portal, and we'll see those come in, and we'll get to them as many as we can, obviously in the interest of time. So with that being said, we'll go ahead and we'll get into it, and we'll just kind of give you a background here of IHC as a company. And IHC actually owns 3 insurance companies outright: Independence American, Madison National, and Standard Security. And we have a wide variety of sales distributions. We work with independent agents, general agents, and we also have wholly owned call centers and an online quoting and enrollment platform called INSX Cloud. We've got a couple direct-to-consumer portals, as you see over there on the right side of the page, including an option for pet insurance for those that are P&C licensed. So we can obviously work with Keith and his staff to get you guys set up with a variety of different products if that's something that has an interest to you. Now, I know in my discussions here with Keith and Victoria, I know they've been doing a lot of business with the End of Funding Advantage product. So some of you, this might be, kind of a rehash of why level funding is valuable. But for those who really haven't done a ton of quoting in the level funded market, you might be asking yourself, why should we be looking at a product like this? And obviously, the main reason, this is a fantastic alternative to fully insured group ACA plans. And this product specifically for the 5 to 75 employee enrolled segment. Now, this is an underwritten product, and by being able to individually underwrite, we are going to be able to see potential savings upwards of 20% over fully insured plans in many areas, not just Michigan. But obviously, being underwritten, this is not going to be a fit for every group, but it does give us something to start a conversation and explore some alternative concepts here. And the way that we've got our SFC product structured is that we're still offering consistent benefits in terms of covered services, deductibles, while adding the potential to get money back and saving money up front through the underwriting process. It's extremely important, especially for those that have not worked with a level funded product in the past, is that we're still dealing with fixed premiums every month. There's no additional risk to the employer. We're not going to come back mid-year and say, hey, you've got a deficit in your claims funding of $20,000. We need money to make that whole. We're not going to do that. The way we've got our stop loss contract and our claims funding mechanisms, we ensure that we've got full coverage across the board for your employers, and we're not coming back mid-year to ask for additional funds.
Hey, John, what happens on groups that run well during the year and they have leftover claims funding?
Sure. So, obviously, the whole concept of this, obviously, we want to save money up front. We want to get money back in your hands at the end of it. And we've got a 12-month run out period. And what happens is we can return up to 100% of that remaining claims funding at the end of the run out period. So we also have a 50% refund option. But by approaching a group health plan like this, and again, we're kind of speaking to those that may not have really worked with level funded in the past, is it's a great opportunity for an employer to get out of that year-to-year mindset and maybe think of health insurance more as a 2, 3, 4 year program where we're realizing these savings and these refunds year after year, and we're seeing that consistency with the same carrier. And like I said, we've got a 50% refund option as well as 100%. And that 50% refund option, that's netting us about a 5% price break over the 100% refund. So depending on if they want to see cheaper rates up front, we've got the ability to do that. Or if they want to see that higher refund at the end, we can certainly do that. And in my experience, I think the biggest refund I've seen go out the door has been like $83,000, and that was on 100%. So they got all $83,000 back. So obviously, it's a huge opportunity for an employer to save money, not just up front, but year after year with those refund options. And lastly, we've got a couple other cost-saving strategies we'll dive into later, including multiple network options and maybe some creative RX options. Now, again, everything we've discussed sounds great. We've got fixed employer premiums, but how exactly does the IHC product work? And each month, the employer is going to be billed for the full premium amount. We'll take into account any additions, terminations mid-year, and we'll adjust the monthly premium by that composite rate. So keep in mind, we're not going to come back mid-year and re-underwrite the group if we add a family or if we term an employee and spouse. They're going to have those composite rates set for that full 12-month term. Now, obviously, if we see a huge swing in enrollment, a company has massive layoffs and we go from 50 employees down to 10, underwriting always reserves the right to come back. I've only seen that happen once in the 6.5 years we've been selling variation of this product. And that's really a last resort option. We really want to try and avoid any changes like that, if at all possible. But in an instance where you're seeing a huge shift in the enrollment, it might be something to take a look at. Now, once we get the full premium in-house, we divide that up into 3 parts, obviously: claims funding, stop loss, and administrative costs. And if an employer has excess claims beyond either the spec deductible per person or the aggregate claims funding, the stop loss carrier is going to make accommodations, as I mentioned previously, to make sure that their claims fund account is whole. So again, even if you've got a deficit of $20,000, we as a stop loss carrier, we're going to advance money into the claims fund, make sure that plan is going to be able to pay those claims. Now, we process our policies based on a 12-month policy period, and then we've also got a 12-month run-out period to help cover those claims that might have been incurred but potentially not submitted yet. And we do return either 100% or 50% of those unused claims back to the group.
Hey, John, do you get a refund if the group renews if another carrier? Excuse me.
So we'll actually return your 50% or 100% of the claims fund back to you, whether you renew or not. We look at it as that's the employer's money, and we don't want to obviously, keep that if you're moving to another employer or another company. So we do return that premium if you're renewing or not.
John, I know that we said we were going to answer questions on the back end, but we got a quick one right here. I think that fits on the slide. It was asked, why a 12-month run-out period when claim lag is generally no more than 2.5 months?
Sure. And, that's a great question. We try and keep this product, obviously, with our name, Simplified Funding Concepts. We want to try and keep it simple and not have too many options. So I know some carriers out there, they have an option for a 12-month run out, a 6-month run out. some things like that. We've actually had instances, they're not, it's not always, the rule, it's more the exception. But recently, 2 months ago, I had a group, they're coming up for a renewal January 1st, and they actually had some claims that came through in month 6 and 7. And in month 7, it was to the tune of about $13,000. So we might be a little over conservative with that, but we have seen some instances where claims are rolling in past month 5, past month 6. So we want to make sure that the employer is completely protected, and we give them that option to, again, cover those claims that are coming in late. So great question, but we actually do not have another option to bring that run-out period below 12 months.
Thank you.
Sure. And so again, this product, it is ACA compliant. It's available for the 5 to 75 market. And recently, that's a recent upgrade for us. We used to be a 10 to 50 focused product, but going to 5 to 75, that's really opened up things, especially in that 5 to 9 space for us. So again, being medically underwritten, we do need individual applications. And we need applications for groups 5 enrolled all the way up to 75 enrolled. So we don't do GRX underwriting. We don't do any sort of gatekeeper abbreviated underwriting. So we do need full applications for that whole 5 to 75 spread. The product itself is underwritten by Westport Insurance Company, which is owned by Swiss Re. And Swiss Re is a fairly well-known name in traditional and large group stop-loss circles. So if you do any of that work, odds are you've heard of Swiss Re previously. That's who we're using as our actual carrier. Our applications are available on FormFire and Easy Apps Online, and we do have a wide variety of deductible options, coinsurance options, office visit copays, things like that will allow us some greater flexibility. Keep in mind, we can go all the way down to a $1,300 deductible, all the way up to $7,900 on a 100% plan, and that's going to kind of work out great with what we'll cover next week in terms of our group gap product. We've got a lot of options that would be a good fit when looking to combine this with some of our supplemental plans. Now, in terms of our pricing, we've got a couple different ways to get to specific price points. One of those is going to be our multiple network options. So we use Aetna Signature Administrators, Cofinity, and we've got access to PHCS. We even have full reference-based pricing, and we'll kind of dive into some of those network options later. But the most important thing here is that we provide the employer with protection, again, if those claims exceed the aggregate claims funding through our stop-loss contract. Now, one of the other things that I want to touch on here that I really, really enjoy with our SFC product is we do have the ability to do multiple drug card plans. So, we've got our traditional 4-tier drug cards where we might have a 10, 20, 5, 40, 100 drug card. That's going to be our richest drug card option. We've got kind of a middle of the road, $10 generic copay, 50 brand name non-formulary, or 100 non-formulary, and then 150 for specialty. But we've got another option, and it's called our value formulary option. And it goes from a 4-tier to a 3-tier, and it's not going to cover that brand name non-formulary drug. So that 3rd tier, it's not going to be covered, but we do have covered alternatives in every therapeutic class of meds approved by the FDA. And we actually can check that formulary list as we go to see if anyone's going to be adversely affected by dropping that 3rd tier. So if we're doing a pre-screen and that comes in, we'll be able to see if that's going to be a viable option, because that actually does net some pretty significant price savings over the traditional 4-tier drug card. And that is available on both HSA and non-HSA plans.
Hey, John, are you able to go into any specifics depending on the pricing between the standard RX and the value formulary plan, and how it protects the claims fund?
Yeah, absolutely. So, the price difference, it's about 7%. That's kind of an average. In some instances, it might be a little bit higher. Some instances, it could be a little lower. But it's a noticeable difference by going to that 3-tier value formulary. And one of the great things about it, obviously from lower premium, is it also protects the employer's claims fund. So think about it. If you've got a brand name formulary drug, and that's what you see on TV today, let's say the copay could be $100 for that. Well, that drug still might cost $900 retail. So where's that other $800 coming out of? If you think about it, first of all, it's coming out of the actual employer's claims fund. So by looking at this value formulary tier, now instead of that $900 retail drug, we might be down at about $350. So if you're saving that much money every month, that adds up over time in your claims funding. You're going to be on track for a much bigger refund when the run out period ends. And one thing that I will say is a lot of carriers, they're already pushing brand name to generic when filling a prescription, unless there's a specific doctor order to fill as prescribed. So that's already kind of being pushed out into the market with some of our competitors. So for a lot of groups, there might not be a huge shift when it comes to this drug card option. And again, like I said, we do have the ability, as we're doing a pre-screen, we can cross-reference the apps with the value formulary list and see if this might be a good option in terms of price savings and protecting that claims fund. Now, again, with regard to plan options, your employees are going to see that this is going to be very similar to fully insured coverage if we're kind of dabbling into level funding for the first time. So they're still going to have office visit copays, prescription benefits, and like I said, deductible options ranging from $1,300 all the way up to $7,900. And one of the things that I really like to point out is if we're running a traditional, I'll say, copay PPO plan, and we've got an office visit copay in there, your first $500 of diagnostic lab and x-ray per day is going to be at no cost to the member. So the plan coming out of the claims fund and then stop loss, that's going to cover that first $500. So the members themselves are not going to see anything beyond $500 applying, until we get past that $500 in claims applying to their deductible and co-insurance. So for the actual individual members, it's a huge cost savings opportunity. And then the other big item would be emergency room services. With us, we apply deductible and co-insurance to emergency room services. There's no copay or no access fee. So other companies, there might be a $500 or $250 access fee or copay right up front, and then those services are still applying to your deductible and co-insurance out of pocket. So, we're taking away that access fee, we're streamlining the cost, saving the employees a little bit of money there. But then we've also got a really attractive urgent care copay of $50. So again, if you're selecting an office visit copay plan, non-HSA, you're going to have a $50 urgent care copay. And that's a great alternative for, I'll say, some of those, emergency situations, but might be a little minor, might not necessitate going to an actual hospital ER or standalone ER.
Yeah, I actually was speaking with one of my top producing agents earlier this week, and a couple of months ago, she had mentioned that groups that she was currently working with weren't going to look at changing carriers, especially carriers that maybe did not have the brand names of your Anthems or some of the other giants out in the space right now for even 10, 20, or 30% savings. They really valued that marquee big name carrier brand. But lately she's been receiving calls from her groups asking what they can do to help them save premium dollars on their health benefits as we have come through a COVID year. She said her groups are now more interested and receptive to learning options on saving premium dollars for as little as 10%. Employers are going to be more willing to work with creative agents in the market today that provide suggestions and cost-saving alternatives, and also working to educate their groups on things like the value formulary drug card and alternative pricing like the reference-based pricing. With that being said, this product is at least a 1-year commitment. So if you have a group that can't commit to 1 year on their benefits or their employment varies month to month, this might not necessarily be the product for them.
Exactly. And obviously, with, COVID, we've kind of been living in this, strange economic environment, business environment for the past 12 months. The more creative solutions we can put out there, the more satisfied these employers are going to be in terms of saving money and just having some alternative options. So everyone on this call, you guys are already forward-thinking agents. So it's a great opportunity for us to really help your employers out. Now, in terms of state availability, Simplified Funding Concepts is available in 25 total states, and we are always evaluating additional states. For example, Oklahoma and Nebraska just got approved. Not sure how many people on this call are going to be doing a ton of marketing in Oklahoma and Nebraska, but as you see here in Michigan, if you're working with groups in Wisconsin and Ohio and Indiana, maybe even Illinois, if you've got some contacts there, we're going to be able to get you covered with the SFC product. And keep in mind, as we go into some of these additional states, obviously in Michigan, we've got Cofinity. That's an outstanding network, one of the best that you're going to find in Michigan. But if we have multiple locations for an employer, we can obviously look at a national network with Aetna or with PHCS, depending on pricing and hospital access. Now, one thing that I do want to mention, if we are working in multiple states or even in Michigan, if a group is with Aetna as the actual insurance company, we're not going to be able to offer Aetna to the group on our particular plan. So we would need to look at either PHCS or Cofinity. If you do have some interest in quoting out west, we do have full reference-based pricing. Think Montana, Wyoming, states that you're not really going to see a strong PPO network. We do have something for you. Now, one of the things that I really like about our Simplified Funding Concepts plan is the multiple network options. And one that I'm really interested in is what we call our Allied Advocate Program. And this is used in conjunction with either PHCS or Cofinity, and it does a couple things for us. It allows us to have the benefits of a reference-based pricing plan with the security of a PPO network. So through the Allied Advocate Program, we are able to engage providers where we have claims in 7 different claim categories. So as you look along the right side of the page, Allied Advocate is really only going to get involved in these particular claim categories. So what happens is if we have a claim going through one of these claim categories, we're going to lead with Medicare reimbursement levels for those particular claims. Now, if a member happens to be balance billed, let us know as soon as possible. We'll engage that provider to negotiate a settlement for that claim. If we are unable to negotiate a better deal for the claim, since it is an in-network physician, we will pay that claim at the Cofinity negotiated PPO rate. So again, the beauty of it is that it allows us pricing advantages up front over a traditional network by having that RVP aspect. But even on the back end, we're going to be able to see significant savings by negotiating some of these higher cost claims. Keep in mind, it's all still in network physicians. So if we're unable to, get that lower payment accepted, they're contractually obligated to accept the Cofinity rate.
Hey, John, are you able to touch on how or reiterate how the vast majority of the claims are not impacted by this, but it's only a small subset of the claims that come into the door, but attribute to a large portion of the cost?
Absolutely. As you're looking at these different claim, categories here where the Allied Advocate program is going to get involved, keep in mind for your regular doctor's office visits, specialist visits, prescriptions, outpatient diagnostic lab, and x-ray services. The bulk of, the claims that you are going to see on a group, they're all being paid out at the network negotiated rate. They're not even going through this program. So realistically, you might have, 4 to 7% of your claims be affected by this program. Everything else is going to be paid out at the network rate. And again, we are proactive. If we see a claim coming through the program, we get reports typically on a biweekly basis. We'll reach out to you as the broker and say, hey, you might want to give Bob's Towing, for example, an update on what happens if someone gets a balance bill. That's kind of our way to let you know, hey, someone's going to have a claim. It's going through the program right now. We want to make sure we get that in as soon as possible so we can be proactive in starting those potential negotiations. Now, keep in mind with the Allied Advocate program, information is also included in the EOB. We include a one-page flyer. This is what you should do if you get a balance bill. And on the EOB itself, we make references to, hey, if something looks odd on your bill, aside from the EOB, give us a call as soon as possible. We'll get involved in negotiating. And like I said, even us as reps, we're proactive with letting you know, hey, we've got something coming up. You might want to have a refresher with your group. Now, we've touched on our regular networks with Cofinity, with Aetna Signature Administrators. We've touched on the Allied Advocate program, and the last option that we have here is our full reference-based pricing model. So with reference-based pricing, if you're not familiar with it, they're going to be able to go to any provider who will accept them. Our RBP plan starts paying claims at 150% of Medicare for facility and 130% for physician services. From there, if we have a balanced bill, similar to the Allied Advocate program, they need to notify us right away so we can start working negotiations with that provider. So in a lot of areas, the full RBP option is going to give us the best pricing, but Michigan, for example, there might only be a 1% to 2% difference in premium. So with that in mind, let's look at using Cofinity with that Allied Advocate program. It's going to give you the guaranteed access to providers in Michigan with Cofinity, and you're also going to see those price savings up front and on the back end for the vast majority of those high dollar services. Now, as we kind of progress outside of plan details, I want to touch on our underwriting process. So with our applications being on FormFire and Easy Apps, that means we're definitely going to be able to do a pre-screen for you. The great thing is, even if you don't have access to FormFire or Easy Apps online, we're still able to pre-screen applications that are completed for any other medical carrier out there. So if you've got apps for the AFA product or UHC All Savers, National General, StarMark, we can pre-screen off those applications. So for new business submission, though, we do need to see our own applications. Now, with that said, we've worked with our underwriting staff, and we are able to accept applications for new business submission from National General and StarMark without even going back to underwriting to request. On a case-by-case basis, we might be able to accept an All Saver application or an AFA app. So we've got a little flexibility when it comes to new business submission, but the best thing to have is going to be our own application. Now, through the underwriting process, the most important thing I want to stress is we want, obviously, like every carrier out there, we want to see the most complete information possible. So we've all seen the apps come through where someone just checks yes to diabetes or checks yes to cancer, and we get no additional information. The more info that we can get up front from you as the broker, getting that from the group, like an A1C reading or a stage for cancer, that's going to give you the most accurate numbers right out of the gate. The other thing to keep in mind is that, we've got a great relationship with our underwriter on a personal level. So we're able to get in direct contact with them regarding a pre-screen or a new business submission, even a renewal. And if we're close, we want to try and work with you as best we can to get an attractive offer in your hand. So we always also scrub all submission documents in-house before it even gets to the underwriter. So we'll try and limit the amount of time that sits at underwriting, and we can have a quick approval once it actually hits that underwriter's desk. Now, in terms of administration, all of our SFC products and plans, they're administered by Allied Benefit Systems out of Chicago, and they're handling our eligibility, claims, billing, And as you write business with us, you're going to receive access to the Allied web portal. And on that Allied web portal, you're going to see information like billing statements, claims running reports. You can even confirm member eligibility and access temporary ID cards via PDF for those employees. So you're going to have that for every group that you write with us. Likewise, each employer should be receiving the same level of access for their specific group. So even the employer could go in, pull their billing statement, claims funding reports, things like that. So they've got a lot of experience administering self-funded plans. You may be working with them currently with one of our competitors, but they've been doing a small group level funded administration for a very long time. Now, in addition to the SFC product here with IHC, we've got a lot of different products available, like our group gap plan. We've got a new limited benefit opportunity. We also have a full suite of individual products that you guys can access through Keith and Victoria.
It's one thing I always tell my agents, and when I'm speaking to prospective new agents out in the field all the time, is that IHC has a solution for everyone. It may not be what you originally, came to us looking for information on, but we have solutions for all of your groups. With this time that we're in right now, dealing with the ramifications of the pandemic, we can offer both group and individual product solutions for your clients. We have multiple individual plans, such as short-term medical, which is great to bundle with our health discount program, which includes a telemedicine benefit.
Exactly. We truly do have something for everybody. And working with Wright, we're going to be able to get you access to those additional products. Now, with that, I want to thank you very much for attending today. Hopefully, we've provided you guys some great insight in terms of our level funded product and how it can be a great tool to realize immediate premium savings, but also the potential to receive a substantial refund. And Grayson, did we have any other questions come through here?
Yeah, we had just one more, and it's a pretty easy one. It's when is the excess surplus refunded, if there's any to be distributed to the group?
Yeah, so the excess claims refund, we've got a 12-month run-out period, obviously, and then what happens at the end of that 12-month run-out period is Allied will actually do an audit on the claims fund report, and they'll go through, and if there's any reconciliation that needs to be done, they'll do that, and it's usually, between, unfortunately, I'd like it to be a little quicker, but it takes about 2 to 3 months, between 2 and 3 months as a rough estimate for those checks to actually get in the employer's hand.
Great. Yep, that was the only other question it looks like that we had on the call, other than the one we had earlier. So
perfect. Well, as we said, we want to get you in and out here in about half an hour. We're 3 minutes over, but I appreciate your time today. Hopefully, we'll get some opportunities out there that will be a good fit for your groups. And as we start working with Wright Insurance, we've actually got another webinar coming up next week. It's going to be focused on our group gap product, and that's a product that I really think is a great fit going forward if we're looking in terms of premium savings and out-of-pocket exposure. So with that, obviously let us know if you have any questions, or obviously please get in touch with your contacts over at Wright Insurance, and they'll be able to help you out. And thank you very much, everybody. I will get any other questions that come through, we'll get those addressed. And, we will make sure we get this hosted online for future viewing at a later date if you're interested in that. So thank you very much, and best of luck out there to you. Thank you.